Welcome to back the battlefield of empirical truth. Here, forecasts stumble against reality, order flows whisper the secrets of price discovery, and algorithms race at lightning speed to reshape the FX landscape. From the Meese, Rogoff puzzle to high-frequency trading's impact, this section uncovers how research dismantles myths and illuminates the mechanics of global currency markets. Chapter 10. Behavioral Finance and Currency Markets. Traditional exchange rate models assume fully rational agents and frictionless markets. However, decades of empirical research suggest that psychological biases, social dynamics, and institutional constraints significantly influence currency markets. Behavioral finance provides a complementary framework to understand these deviations from rationality. 10.1 Foundations of Behavioral Finance. Behavioral finance challenges three classical assumptions. Investors are fully rational. Beliefs are unbiased. Arbitrage is unlimited. In reality, cognitive biases distort expectations. Emotions influence risk perception. Capital and institutional limits restrict arbitrage. 10.2 Cognitive biases in FX decision-making. 10.2.1 Overconfidence. Traders overestimate forecasting ability. Leads to excessive trading and leverage. Empirical studies find overconfident traders underperform after costs. Volatility increases during periods of speculative optimism. 10.2.2 Loss aversion. Losses are weighted more heavily than gains. Traders hold losing positions too long. This behavior contributes to asymmetric price reactions. Slow adjustment to negative information. 10.2.3 Anchoring. Market participants rely on past prices or reference levels. Delays full price adjustment. Anchoring is observed around previous highs/lows. Central bank guidance levels. 10.3 Herding behavior in FX markets. Herding occurs when traders imitate others rather than relying on private information. Evidence shows strong herding during crises. Amplification of short-term trends. Increased volatility. Institutional investors are not immune, particularly under performance pressure. 10.4 Noise traders and exchange rate dynamics. Noise traders trade on sentiment, rumors, or misinterpretations. Introduce non-fundamental volatility. DeLong et al., 1990, demonstrate noise traders can survive and even dominate markets. Rational traders face risk in correcting mispricing. 10.5 Limits to arbitrage in Forex. Even when mispricing is detected, capital constraints limit position size. Risk of adverse price movement exists. Funding and liquidity risks matter. These limits allow inefficiencies to persist longer than theory predicts. 10.6 Sentiment indicators and currency returns. Research uses survey-based expectations, positioning data, COD reports, volatility indices. Findings. Extreme sentiment predicts reversals. Effects are stronger at longer horizons. However, sentiment measures lack precision and consistency. 10.7 Crisis behavior and extreme events. During financial crises, flight to safety dominates fundamentals. Correlations rise sharply. Risk aversion overwhelms macro data. Currencies such as the USD, JPY, and CHF often appreciate regardless of domestic conditions. 10.8 Integrating behavioral and rational models. Modern approaches combine rational expectations, behavioral deviations, institutional constraints. These hybrid models better explain excess volatility, persistence of anomalies, market reactions to stress. 10.9 Key research conclusions. Psychological biases influence FX markets. Herding amplifies short-term volatility. Arbitrage is limited, not infinite. Sentiment matters, especially in crises. Behavioral finance complements, not replaces, classical theory. References. DeLong et al., 1990. Noise Trader Risk. Journal of Political Economy. Barbaras, N., Schleifer, A., and Vishny, R., 1998. A Model of Investor Sentiment. Journal of Finance. Schiller, R., 2000. Irrational Exuberance. Princeton University Press. Minkoff et al., 2012. Order Flow and Sentiment. Journal of International Economics. Chapter 11. Central Banks, Monetary Policy, and Exchange Rates. Central banks are among the most powerful actors in foreign exchange markets. Through monetary policy decisions, communication strategies, and direct interventions, they influence interest rate differentials, capital flows, expectations, and ultimately exchange rates. Academic research places central banks at the core of modern FX dynamics. 11.1 Objectives of central banks. While mandates vary across countries, most central banks pursue price stability, inflation control, financial stability, sustainable economic growth. Exchange rate stability is often an implicit, not explicit, objective, except in countries with fixed or managed regimes. 11.2 Interest rates and exchange rates. Interest rates affect currencies through capital flows, yield differentials, expectations of future policy. According to interest parity conditions, higher interest rates should attract capital. This tends to appreciate the domestic currency. However, empirical evidence shows short-term effects dominate. Long-term relationships are unstable. 11.3 Monetary policy transmission mechanisms. Central bank actions influence exchange rates via several channels. 11.3.1 Interest rate channel. Changes in policy rates alter returns on domestic assets, affecting currency demand. 11.3.2 Expectations channel. Markets react more to future guidance than current policy moves. 11.3.3 Portfolio balance channel. Large-scale asset purchases alter risk premia and asset allocations. 11.4 Forward guidance and communication. Modern monetary policy relies heavily on communication. Research finds clear guidance reduces volatility. Ambiguous signals increase uncertainty. Markets often price guidance before policy action. Central bank credibility plays a decisive role in market reaction. 11.5 Unconventional monetary policy, QE and beyond. Following the 2008 crisis, central banks adopted unconventional tools. Quantitative easing, QE. Negative interest rates. Yield curve control. Empirical studies show QE weakens currencies in the short run. Spillover effects impact global FX markets. Effects diminish over time. 11.6 Central bank independence and credibility. Independent central banks anchor inflation expectations, reduce exchange rate volatility, enhance policy effectiveness. Loss of credibility often leads to currency depreciation, capital flight, inflationary spirals. 11.7 Direct foreign exchange intervention. Central banks may intervene by buying or selling currencies, coordinating with other authorities. Research concludes sterilized intervention has temporary effects. Signaling matters more than volume. Transparency influences success. 11.8 Global institutions, IMF and BS. 11.8.1 International Monetary Fund, IMF. Oversees exchange rate policies. Provides balance of payments support. Promotes currency stability. 11.8.2 Bank for International Settlements, BS. Coordinates central bank research. Monitors global liquidity. Analyzes FX market structure. Both institutions shape global FX norms and policy frameworks. 11.9 Monetary policy spillovers. Research highlights U.S. Federal Reserve policy has global impact. Emerging markets are especially vulnerable. Capital flow volatility increases after major policy shifts. This phenomenon is known as global financial dominance. 11.10 Key research conclusions. Central banks are dominant FX market drivers. Expectations matter more than actions. Unconventional policies affect currencies temporarily. Credibility reduces volatility. Spillovers shape global exchange rate dynamics. References. Meese, F. 2007. Monetary Policy Strategy. MIT Press. Glick and Leduc, 2018. Central Bank Announcements and Exchange Rates. Journal of International Economics. B.S. Annual Reports. IMF World Economic Outlook. Bernanke, B. 2020. The New Tools of Monetary Policy. Chapter 12. Currency Crises, Speculative Attacks, and Global Shocks. Currency crises represent extreme breakdowns in exchange rate stability. They are characterized by sharp devaluations, reserve losses, capital flight, and loss of policy credibility. Academic research has devoted extensive attention to understanding why such crises occur, how they spread, and how institutions respond. 12.1 Defining a currency crisis. A currency crisis typically involves sudden and large depreciation, rapid depletion of foreign exchange reserves, abandonment of a fixed or managed exchange rate regime. Researchers often identify crises using exchange market pressure, EMP, indices, reserve losses combined with exchange rate changes. 12.2 First-generation models, fundamental imbalances. Developed in the late 1970s, Krugman, 1979, first-generation models explain crises as inevitable outcomes of unsustainable macroeconomic policies. Core assumptions: persistent fiscal deficits, monetization of debt, fixed exchange rate regimes. Mechanism: investors anticipate reserve exhaustion. Speculative attacks accelerate collapse. Devaluation becomes unavoidable. These models successfully explain crises driven by weak fundamentals. 12.3 Second-generation models, self-fulfilling crises. Second-generation models emphasize expectations and multiple equilibria. Key insights: governments may abandon pegs to avoid high unemployment. Expectations of devaluation raise its cost. Crises can occur even with sound fundamentals. This framework explains the European Exchange Rate Mechanism, ERM, crisis, 1992-93. Attacks driven by market psychology. 12.4 Third-generation models, financial sector weakness. Following the Asian financial crisis, 1997-98, researchers incorporated financial fragility. Characteristics: currency mismatches in balance sheets, weak banking supervision, excessive short-term foreign borrowing. Currency depreciation worsens balance sheets, triggering banking crises, corporate defaults, deep recessions. 12.5 Twin and triple crises. Empirical studies document twin crises, currency plus banking crises. Triple crises, currency plus banking plus sovereign debt. Such episodes are more severe, longer lasting, harder to resolve. 12.6 Global shocks and contagion. Currency crises often spread across countries through trade linkages, financial exposure, investor herding. Contagion is strongest during periods of global risk aversion, liquidity shortages, policy uncertainty. 12.7 Role of capital flows. Large and volatile capital flows amplify boom, bust cycles, increase vulnerability to sudden stops, reduce policy autonomy. Research shows emerging markets are particularly exposed to capital flow reversals. 12.8 IMF intervention and crisis management. The IMF responds through emergency lending programs, policy conditionality, technical assistance. Academic debate highlights short-term stabilization benefits, long-term concerns about moral hazard, mixed growth outcomes. 12.9 Lessons from major currency crises. Key findings from historical analysis. Fixed pegs are fragile without policy discipline. Foreign currency debt increases vulnerability. Transparency and credibility matter. Strong institutions reduce crisis probability. 12.10 Key research conclusions. Currency crises arise from both fundamentals and expectations. Financial sector weakness magnifies shocks. Contagion is real and powerful. IMF interventions stabilize but do not eliminate costs. Crisis prevention is more effective than crisis resolution. References: Krugman, P. 1979. A Model of Balance of Payments Crises. Journal of Money, Credit, and Banking. Obstfeld, M. 1996. Models of Currency Crises. European Economic Review. Kaminsky and Reinhardt, 1999. The Twin Crises. American Economic Review. IMF, Global Financial Stability Reports. BS, Quarterly Reviews.